All right, ladies and gentlemen, Dutch Brothers just smashed earnings here, up 10% after hours. Now, this is one that's starting to creep back up. Hit a high of roughly $36 a share, came back down in the 20s. Now, we had an ideal price target right around $20 to $23. When we take it down to our models here, call it 21 bucks, but they are absolutely dominating expectations here. They beat their EPS by 350%. EPS expected to come in around 2 cents, came in at 9 cents. We started slowly averaging in around $27 a share. I do think this is a little bit of a higher risk just because of the way the shares are structured. So this is not a stock I would go heavy into. This is not your conventional. It's not your conventional voting shares versus non-voting shares. The way that the shares are set up, I'm not a huge fan of. But we'll get into that in another video. But I did take a small position just because I do think that they are absolutely growing beyond expectations. They did $275 million in revenue for the quarter, which is a 39% increase year over year on top of delivering 10% same-shop sales growth. And now they're adding in applications so people can order online, build customer relationships through apps. This is a huge, huge opportunity. This is a company that's trading under a $5 billion market cap. Now it looks like they're going to be doing over $1 billion of revenue here very, very soon. This is a company still in the growth phase, so there is going to be some dilution taking place and things of that nature. A diluted standpoint, they did 8 cents versus negative 7 cents. This was just an absolute domination on every metric you can look at for a company like Dutch Brothers. And so we're going to start replugging in these models here because they are beating expectations here. Now, I don't think they're going to consistently grow 30%, so I'm going to bump up my projections to about 28%, and we get a future stock price of around $39 here over the next few years. Currently, the stock is trading at 31 bucks a share. So this is something we have to keep updating depending on growth trajectory and all that. I do believe there's going to be factors of dilution taking place here. I'm buying a company that is growing over 25% clearly here. We could even say that this company could grow 30%. And once we put those kind of numbers up there, it gets pretty ridiculous to what we could be paying for this stock. We could be looking closer to about a $40 price target, to be honest with you, for 2032, which means, it's on pace. It's doing everything that I'm asking it to do. We do have to factor in a lot of other things, but very, very strong earnings report overall. Absolutely smashing growth rates. When we look at how much they're growing, the expenses are coming in behind it, but they actually had a net income well before anybody anticipated and earning 8 cents a share already in a very young part of their business cycle. This is a company that's just getting off the ground. Low market cap, trading between, like I said, trading under $5 billion. Trading under $5 billion when I bought it. This is a company that's probably going to do well over $1 billion of revenue on how fast that they're growing here. And they're actually starting to get income from operations in the positive already. And so one of the things we're going to have to fight with on owning a company like this is going to be the dilution. So that's something that you just have to fight with. But even with the dilution, they're still earning 8 cents a share versus negative 7 cents a share prior to. So they're already heading in a positive direction. They built up their cash and cash equivalents to $262 million with long-term liability sitting at $233 million. So balance sheet overall, I don't have any issues with. I'd like to see them just wipe out any debt that they have, even if it takes diluting at this point in time, just because of the interest rate environment that we're currently in. But overall, I think this is a really, really strong earnings. Actually caught me off guard. And the reason why I started building a position in Dutch Brothers is around 20 bucks a share made a lot of sense, but I thought that this company was growing much, much faster. And I like the locations that they're going into. They're going into major cities that have a lot of tourist attraction, a lot of traffic, and they're really focused on the business model here. They run, a lot of their shops run double drive-throughs, and they have the apps. So they're in and out much faster than a Starbucks, which means there could be multiple transactions that take place much faster than Starbucks. I bought because I thought it was at a reasonable price, and I thought that they were outgrowing what the expectations were, and that seems to be the case here. So great earnings from Dutch Brothers. I got nothing bad to say about the company other than, this is in the growth phase, so you have to deal with a lot of shares probably being issued, them raising capital, and that's something that you kind of have to deal with. But when you're growing 39% and 10% in same store sales, and now they're starting to add in applications, which is probably going to get them multiple streams of revenue. Makes this one very interesting. So Dutch Brothers, 2 thumbs up. Really happy about this report. We will see you in the next one.